Hi everyone, and welcome to the first topic of term 2. So this term we'll be looking at financial literacy. All right, so the first thing that we'll be looking at this term is capital. Capital is all the money, goods, and property that a business can make use of to make an income through the activities of the business. So this could be through buying, producing, as well as selling. So capital is divided into 5 main types. We have fixed capital, financial capital, share capital, working or operating capital, as well as startup capital. Let's have a look at fixed capital. Fixed or physical capital is the goods that are used to produce other goods that satisfy our needs and wants. Fixed capital includes machines, tools, factory buildings, office buildings, and trucks and vans. Financial capital is the source of money or funds. For example, someone who starts a factory usually borrows money to rent premises and to buy machines and tools and raw materials. These are known as capital goods. So if I were to start a business, let's say I bake cakes, my fixed capital would be all the machinery that I would need. And then my financial capital would be the money that I need to buy all the raw materials, such as the eggs, the icing sugar, the flour, and the milk. Share capital is the money that is invested by the owners in the business. It provides the funds to buy the fixed capital goods. Working or operating capital is money that is needed in the business to run the business on a day-to-day basis. It does not include fixed capital. For instance, if something goes wrong in my cake business, I shouldn't have to go and look at my investments to be able to fix it. I need to have working capital that will assist me for day-to-day challenges that I might come across. We also then have startup capital, which is the money needed to start a new business. The next thing that we'll be looking at is assets. Assets are the items that have monetary value that are owned by a business. They may include the amounts of money that customers owe to a business. Those people are known as debtors, or that is in the bank account of the business. They include physical assets such as raw materials, machinery, and inventory or stock. These are 2 types of assets, non-current assets as well as current assets. So this is very important. Non-current assets will not be converted into cash within the next accounting year or financial period, which is 12 months. Examples include land and buildings, vehicles, equipment, and investments. So if you have a car, there's no way that you're going to sell your car this month and then buy another car and sell it the next month. Usually the period of a car will be more than a year. Then we have current assets, which can be converted into cash within the next year or accounting period. Examples include inventory, your debtors, and cash in the bank. Next, we'll move on to liabilities. Liabilities are monies owed by the business to other people or other businesses, which are your creditors. So remember, we said debtors are people that owe us as a business. And then if we as a business owe other people, they are known as our creditors. Liabilities include the amount of capital that were either borrowed from the bank or equity. This is the money that the business owners provided, as well as the reserves that the business has. Like assets, liabilities are divided into 2. We either have non-current liabilities, which are long-term costs, such as your mortgage or your bond, or loan repayments. And then we have current liabilities, which include your creditors, and the bank overdraft, which is a short-term loan from the bank when you run out of money. Next, we'll look at income and expenses. In a business, money comes in, which is your income, and money goes out, which is your expense. To make a profit, your income needs to be greater than your expenses. If your expenses are greater than your income, your business is obviously operating at a loss and it's in big trouble. This means that you're losing money. Expenses are payments for services and consumable goods that a business buys in order to keep the business running. Expenses decrease your owner's equity, and they are items which have no lasting value as they are not assets. We have fixed expenses as well as variable expenses. So fixed expenses are as follows. These are the costs that you have to pay every month, no matter how many products or services you provide. These are also known as overhead expenses. They include your rent that you pay for the premises, your telephone account, your water and electricity, and your salaries as well as monthly wages. Your variable or non-fixed expenses are the costs that relate to the amount of products and services that the business provides. Variable expenses increase if more products and services are provided, and they will decrease if fewer products and services are provided. For example, the cost of raw materials and packaging used will depend on the number of products that are manufactured. So here's an example. During COVID-19, businesses were forced to shut down, especially during the level 5 lockdown. So most businesses weren't producing that many goods. This means that their variable expenses went down. However, if the businesses still had to pay rent, their fixed costs still remain the same. Variable costs include payments that you have to make for raw materials, wages, but only if workers are employed only when the production takes place, completed tasks, advertising, as well as stationery and repairs. You would never have a standard amount for repairs because it really depends on what is being repaired and when. Then we have income. Income is all the money that a business earns. A trading and manufacturing business main form of income will be from sales, while a service business main income will be from charging customers a fee for a service that it renders. Income refers to the items that have a positive effect on a person's net worth. They can either increase an asset or decrease a liability. Income increases the owner's profit and can therefore also increase the owner's equity. Other types of income include interest income, discounts, as well as the money that you receive for rent on your premises, which is rent income. Profit. Profit is the money that a business makes after taking all the income and deducting all the expenses. The aim of any business is to make a profit. This is what we call the profit motive. Profit can be seen as payment for the services rendered by the business, for the entrepreneurship displayed by the owner, and for taking the risk to invest money in the business. Some articles have a low profit margin, especially when they sell quickly, so a high turnover. For instance, groceries. Others which sell slowly, such as furniture, have a higher profit margin. The profit must be such that the business can compete with other businesses, it covers all its expenses, and gets a fair income. Any profit that is gained goes towards the business owners, who may decide whether they want to spend it on the business or not. So this is how we calculate profit. You take your income, you deduct your expenses, and there you have your profit. So what is a loss? A loss can be described as the loss of money or the decrease in the financial value. A net loss in a business is when the expenses are more than the income earned in a certain period. A loss can also occur when a business sells an asset for less than it is worth. Any loss that takes place will decrease the owner's interest in the business, so this will decrease owner's equity. When we talk about how much money a business has made during a specific period, we could say that the business shows a profit, which means that they made a lot of money, more than in their expenses, or they ran at a loss, which means that their expenses outweighed their income, or they broke even. So this means that the business hasn't made a loss, but they also haven't made a profit. So their income equaled their expenses.